Over the past year, it seems like all anybody could talk about was inflation, the impact that it would have on individuals, businesses, and the overall economy. Now, with the Fed aggressively trying to fight inflation, the biggest concern is what comes next, and what a lot of people are really worried about, it's not just a recession, it's deflation. In this video, we're going to talk all about deflation. Where are we at in the cycle, what it is, how it impacts you, and make sure you stick around to the end where I share what you could do now to prepare yourself for a deflationary environment. Before I do, I'm Jonathan Rankin. My firm and I have been helping clients plan and execute their retirement plans by focusing on three key areas: maximizing their retirement income, optimizing their investments, and reducing taxes. If you're thinking about retiring or already retired, make sure you subscribe so you don't miss any of our retirement videos or episodes of our retirement podcast called The Retire One Show. Now on to the Fed's next big issue. As you know, the Fed has been aggressively raising interest rates to fight inflation, an issue they are pretty much responsible for creating by keeping monetary policy easy at the wrong time. I mean, by June of 2021, inflation shot up to 5%, and the Fed was still at zero interest rate policy and continued to expand their balance sheet hand over fist. The Fed didn't think inflation was going to last. They kept using the word like transitory, so they messed up when inflation was getting hot, and now they're trying to make up for it by being overly aggressive to fight it. And that's where we are today. The Fed warns of pain, almost like they want to punish us for their policy errors. Now, it seems like the only people that are worried about inflation is the Fed, that have been tightening aggressively into a bear market in equities, a slowdown in real estate, a huge drop in commodity prices, and a very strong dollar, which sets up to a perfect storm of what everybody else is starting to sound the alarm on, the next issue, deflation. First, let's talk about what deflation is. Deflation is when consumer and asset prices decrease over time. Sounds great, right? Prices have been so high, it's nice that things are starting to go on sale and get a little bit cheaper. But in reality, this is actually a lot more devastating than inflation. As prices drop, consumers actually reduce spending because they believe that things will keep getting cheaper. And this is where falling prices can turn into an economic downward spiral. Because people delay purchases in the hopes that they can buy things for less at a later date, that means lower spending, which leads to less income for producers, which can lead to unemployment and overall lower demand because you have higher unemployment. And the cycle keeps continuing, which is why deflation is typically associated with an economic recession. See, a recession refers to a decline in economic activity as measured by GDP, whereas deflation refers to a situation where consumer prices and assets fall, and that's measured by CPI. Both, however, result in low investments, low incomes, high levels of unemployment, and lower outputs. And that's why deflationary cycles are typically associated with a recession. Now, here's a perfect example of this happening right now. Recently, Target and Walmart came out to say that they are going to have to start reducing prices due to an overstock of inventory. And then just the other day, you have Gary Vee posting this video to his audience of over 10 million people.
Oh, I love this. I've got to get on this headline. So many people underestimating how scary it may get in the next 3 to 6 months with the macro economy. This is absolutely the time to be thoughtful about a big purchase. Houses, cars, renovations. And then forget about big purchases, small purchases that add up. Ubers, expensive coffees, 7 streaming services when you only use 2. Get thoughtful. Look at that credit card statement and see how many things you're paying for each month that you haven't canceled yet. Start getting smart, because it's hairy out there.
But just listen to what he said. So many people underestimating how scary it may get. Having a person with such a large following like Gary Vee tell his audience to hunker down and hold off on spending, I mean, what kind of impact does that message send about future demand? And you also have Cathie Wood, the CEO of ARK Invest, post an open letter to the Fed saying the Fed is making a policy error that will lead to deflation. She goes on to talk about how the Fed seems to be basing its decisions on 2 lagging indicators, employment and headline inflation. Her letter had the support of Elon Musk as well as bond guru Jeff Gundlach. Then comes Wharton School economist Jeremy Seigel, who warned that a hawkish Federal Reserve risked pushing the economy into a depression if it waits for core inflation to return to 2%. Now, he's not just talking about a recession here. He's saying the word depression, like back in the 1930s. Now, the finance professor also believes it's an issue that the Fed is using a lagging indicator like CPI and cited that real prices, including home, commodity prices, freight rates, are all coming down. He also said that money supply, a big part to the inflation story experienced over the past 2 years, has experienced the most protracted decline since World War II. The Fed exploded the money supply in 2020, but inflation didn't show up until 2021. Interest rates going up are going to take time to work through the system. So you have Cathie Wood, Elon Musk, Jeremy Seigel, Jeff Gundlach, and the list goes on and on of highly respected people banging the drum on deflation. But what are the numbers actually showing? Well, used car prices that are down over 10% year over year. Commodity prices outside of food and energy have fallen off a cliff. Look at this chart of the most watched supply chain metrics that have been falling and are close to pre-pandemic levels. Refinancing index has fallen to the lowest level since 2000, and home builder sentiment about future sales is at its worst level since 2012. With deflation being a big concern, and the numbers are starting to show that it's starting to rear its ugly head, the next common thought is the fear of an economic slowdown or recession. And we're already seeing warnings of recessions all over the place, from JP Morgan's CEO Jamie Dimon, who believes that we'll see a recession in the next 6 to 9 months, to Goldman Sachs' CEO David Solomon warning of a recession next year, to now Bloomberg's economic model forecasting 100% odds of a recession in the coming 12 months. That's up from 65% in this last update. 100%. That's not leaving any wiggle room to be wrong there. When they say that in life the only things that are certain are death and taxes, well, not according to Bloomberg. I guess we can add 2023 recession on that list. With all of this, what can you do? Well, if you're retired, keep cash on hand. Don't get caught up in the thought that purchasing power is being eroded because of all the inflation headlines and that you're not earning anything on your cash. Just be patient, especially with large purchases. But what if you're not retired yet? Well, the same goes for keeping cash on hand and being patient with large purchases, but there are other issues that you have to think about. When we're headed into a recession or we're in a recession, we typically see layoffs, which despite the strong employment data, we are already seeing signs from major corporations like Goldman Sachs, Intel, Microsoft that have already announced layoffs of thousands of employees. In fact, there's a website that tracks layoffs in the tech sector, and year to date, there are 690 startups with over 91,000 employees laid off year to date. Now, some of that you can't control, but just to be prepared, there are 5 things that you can do to prepare yourself for a recession. The first thing is use this time to pay off debt. Second thing you could do, make sure that you have an emergency fund built up. 3 to 6 months is typically what's preferred, but the higher that you can get, the better. Number 3, keep an updated resume. Well, that really leads us to number 4, leverage LinkedIn. Use this as your digital resume and Rolodex in one spot. Use this time to connect with current and former colleagues. Build your network. Just in case something happens, you have an easy way to reach out to people and see who might be hiring. And lastly, update your financial plan. With asset prices down and the potential of income being lost, you really want to see what your financial life looks like under all possible scenarios. Now, if you don't know where to start, if you have questions, or if you need help, use the link below and let's schedule some time to connect. We'd be happy to help you with a free retirement analysis. If you found this video useful, please click the subscribe button. It helps us to continue to put out content like this, and make sure you check out our weekly retirement podcast called The Retire Once Show. Once again, I'm Jonathan Rankin. Thank you for watching.